video. So it's always a bit difficult to invent something which I have to tell, but so I don't like to speak, so I rather show a video. Alex is more the technical guy.
The third indispensable element in building the new prosperity is closely related to creating new jobs and halting inflation. We must protect the position of the American dollar as a pillar of monetary stability around the world. In the past 7 years, there's been an average of one international monetary crisis every year. Now, who gains from these crises? Not the working man, not the investor, not the real producers of wealth. The gainers are the international money speculators. Because they thrive on crises, they help to create them. In recent weeks, the speculators have been waging an all-out war on the American dollar. The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Now, what does this action, which is very technical, what does it mean for you? Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as much tomorrow as it is today. The effect of this action, in other words, will be to stabilize the dollar. Now, this action will not win us any friends among the international money traders. But our primary concern is with the American workers and with their competition around the world. To our friends abroad, including the many responsible members of the international banking community who are dedicated to stability and the flow of trade, I give this assurance. The United States has always been and will continue to be a forward-looking and trustworthy trading partner. In full cooperation with the International Monetary Fund and those who trade with us, we will press for the necessary reforms to set up an urgently needed new international monetary system. Stability and equal treatment is in everybody's best interest. I am determined that the American dollar must never again be a hostage in the hands of international speculators. I'm taking one further step to protect the dollar, to improve our balance of payments, and to increase jobs for Americans. As a temporary measure, I am today imposing an additional tax of 10% on goods imported into the United States. This is a better solution for international trade than direct controls on the amount of imports. This import tax is a temporary action. It isn't directed against any other country. It's an action to make certain that American products will not be at a disadvantage because of unfair exchange rates. When the unfair treatment is ended, the import tax will end as well. As a result of these actions, the product of American labor will be more competitive, and the unfair edge that some of our foreign competition has will be removed. This is a major reason why our trade balance has eroded over the past 15 years.
So the title is "The Real Criminals Are Not in Bonanza," because this speech was 71, I think probably autumn, and it was just coming in the TV in the US before Bonanza. And it's not against Anton Greber, which is our lawyer, but my family comes from the south of Italy, and there's a famous saying from Don Corleone who said, "One lawyer with a suitcase and a tie can steal 100 times more money than 100 of my enforcers working on the street." And You know, if you listen to this, stabilize the dollar and all these things, it's yeah, it's really a funny thing. So my presentation, I have to take notes because obviously my brain is not getting better, and we had some wine yesterday with the Norwegians, so the memory is also not getting better. So I have to read a bit from the things. But this is the trade balance. So, you know, on the short end, we are close to $1 trillion now. Or on the long end, you know, they removed the dollar backing with gold in 71 to improve the trade balance. And you see, it was very successful now. Particularly also like your dollar will be worse tomorrow as much as today. It was also very successful. But I'm coming to my speech, which is a bit something I have read from a good hedge fund, which is a macro guy, and he makes some comparison to the 70s, which I want to show, which are some similarities, but also maybe some things which are not the same. I listened to the interview of this guy, Hexet is called, the head of treasury, with Tucker Carlson, which went for a year, and it was quite interesting, you know, and he said, you know, in the US we have to go back to before 1913. So this is what is being said. So what was before 1913? The US didn't have a Federal Reserve, which is not federal and doesn't have any reserves, by the way. And the US didn't have any income tax, because still today in the US Constitution, it's forbidden to directly tax the citizens. By the way, in this country, the income tax directly from the federal government was against the Constitution for 60 years as well, because in Switzerland, the federal government is only allowed to tax people directly in war. So our Bundessteuer was introduced in the Second World War as a war tax, and of course it was temporary, and it was never abandoned, and in 92 they changed it and so on. And this Hexet said, you know, the problem about this monetary system is you print money, and then you have asset inflation. The Fed has the so-called dual mandate. I think gold price was, I don't know, $33 or 20 at the beginning. Today it is where it is, so it's very successful to keep the buying power of the dollar. And he said, you know, the problem is when you have this money printing, you have like this parasite businesses like ours, which just benefit from asset inflation, and you take away a part of the inflation. And it means that the coast in the US became richer, all these businesses like finance, legal, and etc., but the working class in the US was eroded because with the asset inflation, the production of goods became more expensive, and you have a complete loss of the middle class. And if this continues, you're going to have somewhere a revolution like we had in Russia in 1917 it was. So you have to try to stop it. Now we don't have to discuss if this is going to be successful or not. But obviously when there's only one person owning everything and the other ones don't have anything to live off, you get a revolution at the end. So there was like a recent, now you say, you know, this is ridiculous, you know, like this American president coming out with some taxes written on like a restaurant owner in Italy who says the menu today is this 20% and so. Now, are these people so stupid, or is it maybe also the opposite? So there was a friend of mine who is here, who always sends me the newsletter of Mr. Hummler, which was the former Wegelin guy. I have to say, and it's in German, but I have to say it's so complicated. In German, I always have, when I read it, new words, which I have never heard in my life. So I said, what does it mean, this word? I've never heard it. So but he said, you know, this is by coincidence, you know, that the American, you know, going back, deglobalization, they tried to create as much havoc and as much problems that they can leave Europe and say, okay, we concentrate on our continent again, which might be true or not. But if you start introducing tariffs like Nixon already did, of course, if you have, like in Switzerland, you had a lot of white wine, which was sour and nobody wanted to drink. then you protect the consumption of this and you put a tax on foreign white wine. But you cannot put a tax on everything because, you know, like in our business, and this is the example of copper, you know, this is not about the price of copper and the tax because the production in the US is not depending on the copper price, really. It's more depending on many things like legal structure, etc. Like Marcus, before my time, so they had one of the biggest copper projects in our fund, which is Pebbles in Alaska, and I think it was discovered in '87. And the big companies spent more than $2 billion on it, and they're still trying to get an environmental impact study, and just lawyers became rich with that. This is an example. The US, for example, in copper imports 50% of their consumption, mostly from Chile, which is obviously the biggest copper producer. And you see the premium in the US, you had this huge increase in the spread of US copper prices compared to London, because of the fear of tax, import tax, and then it was abandoned. By the way, Glencore, my neighbor in Bar, he made a lot of money on this trade, like always. But you know, if you want to have really an investment in the country in such businesses to become self-efficient, I mean, you don't need these kind of things. You want to have stable situation in many things, because this is a business where you have to invest billions, and it takes 20 years to build. So it's a bit a strange behavior, but it is how it is. Then maybe coming back to the 60s and 70s, we also had a bit comparable situation with very low interest rates in the 60s, which led to the Nifty 50 bubble, which today would be called the quality growth, you know, like this cash flow rich, or then maybe not so cash flow rich companies anymore, like Nestle, which became a financial engineering companies. But obviously with lowering interest rates, you had a higher valuation of these so-called bond-like cash flows. And we know what happened then after Nixon made this announcement. This is something from an economist called Minsky. You might have heard the Minsky moment, but he makes a differentiation of three kind of companies quoted in the US stock market: hedge, speculative, and Ponzi. And hedge are companies that can cover with their revenues the interest costs and the principal repayment. Speculative companies who can only cover the interest costs but not the capital repayment of the debt. And Ponzi are the companies which can't pay with their revenues either the interest payments or the capital repayment. And in the US, this has now reached 40% of all quoted companies who cannot cover with their revenues interest payments and capital repayments. So you would call it maybe growth today, and so. But that's maybe a bit a bad thing. Now coming to just a little bit of comparison. So obviously I'm in the natural resources space in 30 years, so I don't have a clue about this complicated, very sophisticated technology. I can hardly put on the PC on my desk, if I'm at my desk, which is not that often. But some comparison, you know, like NVIDIA is, I guess, a good company, but it has a nearly 5 trillion market cap. So it's the same market cap as the GDP of countries like India or Germany, which are the third, the fourth, or Japan, the fifth biggest economies in the world. And then on the right-hand side, you see this, what we all know, this concentration of these magnificent few stocks. Quite interesting if you compare the amount of companies and the market cap, it's always a bit the same, you know, countries which are very different, China, Europe. So, and obviously you have these few companies which are so big, so I'm a bit, let's say Italy, which bad people would say, my wife wouldn't like it, but they would say it's half Africa. But you could argue it's not, but Italy is the 8th biggest economy in the world. And if you make a 15% capital increase with NVIDIA, you can buy tomorrow the whole market cap of a country like Italy. And maybe a comparison was also in Japan in the 1990s. There was like the valuation of a park in Tokyo. If you would sell it, which you couldn't, but you could buy all the real estate of the whole country of California. And the thing is that also this valuation depend on asset flows. It was the same in Japan and now in the US, and you need external asset inflows to keep that up. And if you look at, for example, sectors like growth or tech, it's depending on the strong dollar, which depending on foreign asset inflows, which I come later a bit. And also this called innovation, it's also depending on that, because if you have a lot of cheap money available, you tend to have more money available for private equity, venture capital, and all these things. And for example, like in Switzerland, people always talk about the value or the costs of labor. But what they forget is that the cost of capital is evenly or even more important. So if you have a strong currency, you have tendency lower interest costs, so you can afford to invest more in cash flows which are further away. Let's call it R&D, development, and all these kind of things. So now I'm coming a bit to the 70s. We had obviously this problem about the dollar, which failed, and the US was actually defaulting on its monetary system, and that was 71. And then you had like a devaluation of the dollar, and the gold price went from from 30 to 800, and the gold price was leading as well. So surprisingly, in the US, when 71 happened, at the beginning there was a huge turmoil in the markets, particularly on the forex market. But it was the dollar was even strengthening. The Japanese yen, after this announcement, lost 20%, etc. Everybody believed in a new deal, a Smithsonian deal it was called. And much later, in 74, you had problems with the stock market, and interest rates and all these things happened in the 70s. For example, the oil price was in autumn 73 at $3, and within a year it multiplied by 4, going to 12, and then at the end of the 80s to 50. Now, if you have heard this story, what said Nixon? Obviously fix the fiscal problem. And so America had a lot of fiscal problems due to the Vietnam War and their new society projects. And obviously the French saw that they created a lot of money which can't be covered in gold anymore, so they took gold. They said, okay, we do tax cuts for businesses, Nixon, and obviously we will equal it with government spending, which goes down, and they put in wage price control and 10% tariff on 50% of the imports. We saw what happened with the trade balance. And America will always be trusted as a trading partner, everything, and the usual blah blah. And there is not going to be any intent to devalue the dollar. And obviously they did not, or did. And the fiscal credibility, and so on. Now a bit the difference to the 70s, to restore the trust in the US dollar and to keep it as a reserve currency, Volcker had to increase the interest rates to more than 15% at the end of the 70s. And what is more important is Kissinger, which created the petrodollar, which is the origin of today's reserve currency. Kissinger, by the way, said having America as an enemy is dangerous, but having America as a friend is fatal. And he should know, as he's obviously a very influential man and was the foreign minister of the US. And I have to come back. The interest rates were one thing, which is often talked, but the petrodollar, which was created in 74, is, in my opinion, much more important to keep the dollar as a reserve currency, because it was the origin that all the countries, at least in the bloc, had to recycle their trade revenues at the end into treasuries, which is the reason why the whole world financed these deficits. And I don't want to get too long on the history of this petrodollar, and you can think about, this is today's Saudi Aramco, which was nationalized in 74, which is, if you look back, the oil interest of Chevron and Exxon, which were many companies back then. But do you really think that the Americans just gave this asset, which is still probably the most important asset on the world, to a few Arabs? Just like this, you can have it in nice people and so. So obviously there was a deal, and so to keep, to trade this in dollars, but more importantly to recycle it into treasuries at the end, which is the safest way to keep dollars. And if you look at the history, whenever a country wanted to go out of this agreement, there was bribery, then some politicians might have a plane crash, or you have like a direct military intervention. An important person told me once, if somebody believes the value of the dollar is really depending on economics, he's a complete fool. It's purely depending on military power. And it was really an important person who have known this. Now, what is now a bit the difference of the 70s and today, in my opinion? This is the interest payment of the US federal government, And the problem is, obviously, the higher the debt level is, the more problems you get when you increase interest rates. Because the level of debt is completely unimportant. What is really accounting is the payment for debt serving. It's like if you have a mortgage, it doesn't matter how big it is, whatever. It's just how much money do you have per month to pay your interest. And this is the problem about the future of our government debt. This is the US, but it's the same everywhere. Nobody can afford it anymore. So you have to lower interest rates. And this is what's going to happen, that now the 30-year treasury bond disappeared already many years ago, and the whole refinancing will shift to the short end of the curve, because you see the charts of long-term interest rates, they are looking like gold. Everything breaks out on the upside. The worst is the UK, which is the shittiest country on the planet in terms of financially stability. So nobody can afford this payment, so it will mean they don't issue long-term bonds anymore, so the refinancing gets to the short end. That's why you lower the interest rates on the short end. The curve makes like this. Maybe you can manipulate the long end. We call it yield curve control, buy a few bonds. But it means more and more money is issued on the short end, and you have to refinance it quicker and quicker every day. So if you do this, and if you would have been an emerging market country historically, it's the direct way into hyperinflation, because you already have too much debt, inflationary pressure structurally, and then you lower, and the government starts paying this, but maybe this time is different. But maybe the gold price is showing us something. So the last slide, and afterwards I will read something from my notes. But this is something which is, in my opinion, very important, that the Western power can still keep control of the whole savings in the world, meaning that everything is getting recycled into treasuries, let's say the petrodollar. It's quite interesting if you look at the BRICS report, which comes out from an Australian university. Annually, they show this development in financing with BRICS. Obviously, this is not published in the West, but Australia is also the West, but it has obviously a complete dependence on Asia, on its commodity exports. And what is being done, and it's exploding massively, that, for example, China tells or goes, let's say an example, an oil refinery in Iraq for 10 billion, China goes, how do you avoid the dollar? You go there and say, okay, we built the refinery, we finance it, but the future payment is in all the oil streams for the next 50, 100 years, etc. And this is obviously why Western politicians, particularly in the US or also in the EU, get so aggressive, because this is stopping the refinancing at the end of this trade deficit and the deficit of the government in the Western world. This has been announced just a few days ago in this SCO, it's Shanghai Corporation or Organization, whatever. It was founded by these stunned countries with Russia, but today there are more important countries, member of it, let's say India and China. And this is the New Deal of Power of Siberia 2. And you see, Power of Siberia, or the Russian, not Power of Siberia, the Russian gas supply was actually the reason why we had an industrial boom in Western Europe for 30 years, 40 years, particularly in Germany, which is the most important countries. Now, on the right-hand side, you see that these gas fields, these Yamal fields, were connected with this Yamal pipeline, which is 4,000 kilometers, and then it's distributed on the left through various pipelines, through Nord Stream, through Yamal, through Poland, through the Ukraine, and to the south. And the amount of gas being bought by Western Europe was around 50 billion cubic meters per annum. And it was cheap energy, which allowed us to be competitive in Western Europe. Now, Power of Siberia 1 was built a few years ago with an original capacity of, I think, close to 20 billion cubic meters. But Power of Siberia 1 connected new gas fields in the east of Siberia towards China. So it didn't affect the existing capacity of Yamal fields. But now this announcement of Power of Siberia 2, which should cost 7 billion, no, not that much, this is now connecting these existing Yamal fields directly to Beijing and Shanghai. And this is a capacity of 50 billion cubic meters, which is exactly the whole amount what the Western world, Western Europe imported annually for the last 30 years. And this will end cheap energy forever in Europe, because these fields are now being connected to Asia. So it's gone. For example, a reason why we hold some Norwegian assets in our fund, oil companies, which were cheap, but actually Norway is the only energy provider anymore towards Europe. And of course, a very expensive LNG from the US. So our friendly competitor, which is called Göring Rosenzweig, is very bullish on gas in the US, which I think he will be right at the end. And obviously we also hold gas, because every oil company has 50% gas. And gas is a byproduct also mostly from the oil production, particularly in shale. So let's see if there is really the reason that this Göring Rosenzweig is right on their gas supply. I wonder if the good Americans really are ready to distribute their gas to Europe, and their own industry, etc., are having a shortage. I'm not so optimistic on that. So I have some personal interest in farming in Australia, and there was, like, in the gas crisis, a big issue in Australia already, that Australia is a big LNG producer, the third or the fourth biggest in the world. So they have a lot of coal, which Glencore owns now. They have uranium reserves, which are not allowed to produce in Western Australia due to political reason, and gas. So the gas, coal, they don't have any utilities to burn it. The gas, they would have power plants, but they committed all the gas already with long-term contracts to Asia, Japan, China, and they didn't have any power anymore in Australia, because the gas they would have had, but they were committed to Asia. There was a big discussion. You had blackouts in Australia, and in the mining industry, you know, it's energy intense. So why should we send our gas to Asia, and our own industry suffers? And Australia is obviously very dependent on Asia, and it's a small country, so they fulfilled their contract. So I'm not so optimistic that if the same would happen in the US, we could be as lucky as we were with Russia. But to conclude, I just read a few words from this interest rate letter, which compares it a bit, a very good macro investor. In the late 60s, when it became clear that the global monetary system was increasingly unfit for purpose, the strains began to show in the rising value of gold. Inflation, the rising distrust of American institutions. The culmination of these pressures was Nixon's unilateral decision to renege on the Bretton Woods agreement and discontinue the convertibility of the dollar into gold. This amounted to the de facto dollar default, which destroyed the purchasing power of the currency in the following decade. The 71 announcement was a clear example of the United States believing, wrongly, that it was powerful enough to speak out of both sides of its mouth without consequence. Nixon government blindsided allies and foreign holders of dollar assets by inflicting heavy losses on them, while also insulting their intelligence by claiming that the United States has always been and will continue to be a forward-looking and trustworthy trading partner. Remember, a big part of the world was still in the communistic bloc, so we talk only about Western countries. So do you really believe when in the future China trades something with Iran, they will settle it in dollar and recycle it into treasuries, and if you don't behave well, your account gets frozen? But okay, you can be optimistic on that. That trust would not be re-established until the early 80s and would be won hard. inflicted sufficient pain on the US economy to crush inflation and convince global markets that American institutions could once again be trusted, that gold could be substituted with US Treasury as a safe reserve asset. And so began a 40-year bull market in bonds. So maybe lowering interest rates in today's world is maybe not the same like Volcker did. These days, most Americans will try to convince themselves and anyone else who will listen that the current situation, everything ranging across the realms of the cultural, fiscal, geopolitical, and judicial, whatever, and anything else might think of as a burden of blame to place solely at the door of one or the other political parties. The decades-long fiscal deterioration of the United States is a clear example of a situation where both sides of a political aisle have presided over the destruction of American institutional credibility to remaining election cycles. These problems should be very familiar to today's investors. Furthermore, the solutions to them proposed by Nixon in the late '71 bear a remarkable similarity to those being proposed by Donald Trump in '25. Reduced government spending, smaller government, tax cuts, tariffs, unilateral decisions taken without consultation with strategic partners, inflation and the cost of living crisis, and later a New Deal. Just to finish a few simple words, United States, and this is just, you know, the West, the European Union is just, this is just, how it's called, was heißt auf Deutsch? Yeah, a colony, yeah, Vassal, exactly. United States, which should be obvious to everybody now if you listen to the United States total public debt to GDP ratio rose from 107 in 20 to 121 in Q1 25. Total public debt rise from 23 trillion 20 to 36 trillion in Q1 25. A rise in the fiscal deficit to almost 7% of GDP. Interest costs on debt that run to $1 trillion or 3% of GDP in 24, and we saw the chart, what's the future going to be? Obviously, if you would leave interest rates freely. Interest costs on the national debt becoming larger than the defense budget. The prospect of sprawling mega bill, the big beautiful bill, that the CBO projects will add more than 3 trillion to the US debt, estimated 130% of GDP by 34. A proposed 5 trillion increase in the federal debt ceiling, which would be the largest ever one-time rise in that limit. A failed experiment, fiscal consolidation, Doge, or what's it called, with this Elon Musk guy, you know, they claimed they could cut 2 trillion of spending versus the deficit, federal budget of 7 trillion, before adjusting the goal to 1 trillion, and then claims they have cut 170 billion. And independent estimates believe it's less than half of this figure, so virtually nothing, because it's always the same. Chaotic, sporadic, one again, off again trade war, a repeat of the Nixonian 10% tariff on all imports, blah, blah, a lack of clarity with strategic partners, political pressure from the White House, on the Treasury, on everybody. So there are many similarities to the 70s, and in the 70s, you know, and if you look at the whole markets, declining interest rates structurally led to this, what we have the last 40 years, you know, all these cash flows, interest rate related, we would call it growth to value and all these things, and I think this is definitely changing and so on. We also already see the signs, and if somebody's interested, I have a good piece of research at home. It's called The Value Investing in Times of Inflation, which by some German guys who wrote what Buffett did in the 70s, which was very successful, how business model changed in the 70s with rising interest rates and interest costs. But what you should definitely not be depending on external cash flow for your business, because this is good if interest rates are declining. And I have some 2 minutes because I'm a stupid person living in Zug, and I should have done the following business. You know, it would call clean, we clean. So if I would have founded a cleaning business in Zug, and I say I clean every flat in Zug for $20, obviously, even my wife would order me, and just for cleaning, not for something else. She's not here. So, you know, within a year, I would clean every flat in Zug for $20, and I would say, yeah, you know, growing like hell and so, and but I need money because I have to buy the vacuum cleaner and all this thing. And I say, but afterwards, you know, when we clean a whole canton, I make a lot of money. Okay, but it's growing so massively. after years say, okay, we can apply the same to the canton of Zurich. I do also clean every flat in the canton of Zurich, and still grows, but even more investments for new vacuum cleaners, everything, and then Switzerland, and then the whole world. At the end, this business was just selling $1 for $80 because you cannot really clean a flat for $20. And I was depending on external cash flows. I would become a billionaire because I was going to the stock market, etc. But this is depending on cheap money, external money, you know, low interest rates on the high yield, venture capital, etc. And so I want just to close my little speech that we're going to have problems with businesses which are not depending on internal cash flows, but external cash flows. So hopefully you understood, because I didn't. Thanks a lot.